Mr. Chairman, and thank all of you for your testimony here today. Mr. Reiners, in your testimony, you argue that bank regulators should learn from previous incidents where crypto failures impacted the banks that they worked with. And I agree. Earlier, back in December in this committee, we heard from Professor Hillary Allen, and she made a case for a Glass-Steagall 2.0 model separating banking entirely from crypto asset activities. In your testimony, you indicate that that's probably beyond the agency's authority to do, even if they wanted to do it. And you urge that we look at other alternatives to develop a comprehensive framework that clarifies, and I'm quoting from your testimony here now, a comprehensive framework that clarifies the type of crypto asset activities banks can engage in and the prudential requirements, capital and liquidity required to engage in such activity. Could you expand on that and provide a little more detail as to what you're thinking?
Yeah, thank you, Senator. And I'm a friend and admirer of Professor Allen's work, and I certainly agree with the sentiment that we should do everything we can to restrict crypto from entering the banking system. But as long as crypto's legal, then these firms are entitled to banking services. So I think the challenge is, where do you draw the line? What specific crypto activity can be done in a safe and sound manner? And so I think the banking agencies have started off on the right foot and having guidance in place that says if you're a regulated bank, so this is the FDIC, OCC, and Fed, all have guidance in place that says if you're a regulated bank and you want to engage in crypto activity, you have to let us know first. But again, I think more is needed. And so what I recommend is that banking agencies do a horizontal exercise where they understand all the different ways that banks are exposed to crypto and then release that information to the public so that not only bank customers, but bank investors as well are aware of the risk, because the guidance hasn't been perfect. And we've seen a few banks that, unbeknownst to regulators, were more exposed to crypto than previously realized. And I would just point Silvergate as a perfect example. Over 90% of their deposits were from crypto-related firms. In the fourth quarter of last year, they saw over $8 billion in deposits leave. That was over 60% of their deposit base. And it looks likely that they would have failed if they did not get emergency liquidity from the Federal Home Loan Bank of San Francisco, which of course is not the reason that we have federal home loan banks. They exist to support home ownership, not to bail out banks that gamble on crypto. Again, I think the challenge is, where do you draw the line? The Basel Committee finalized their guidance in December. The U.S. has a history, of course, of gold plating, as they say, Basel standards, and I think that's certainly warranted in this case as well, because if crypto had been more integrated in the banking system, the fallout of FTX would have been much, much worse.
Right. No, I think that's a really important point. And I guess to just ask you to expand a little bit more on this, do you think our banking regulators are taking all the steps that they are authorized to do under current law to try to prevent crypto from sort of making its way into the banking system in a way that puts consumers at risk? Is there any additional measures that they should be taking? And if they've exhausted their authorities, do you support legislation along the lines of that Professor Allen suggested?
So banking agencies have broad legal authority to prohibit banks from engaging in any activity that can't be conducted in a safe and sound manner. So I do think that they can do more and be more prescriptive around what specific crypto-related activities can and cannot be done in a safe and sound manner. For instance, there is absolutely no reason why banks should hold cryptocurrency as a principal on their balance sheet. Now, the joint statement that the banking agencies released at the beginning of January alludes to the fact that the agencies would look very askance at banks that wanted to do that. But I think certainly clear guidance that just says you can't do this is warranted.
Got it. Thank you. Thank you, Mr. Chairman.